As to this webinar, it's for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. TSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and the results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured we take your privacy very seriously, and we will not distribute or sell your information to anyone. Fantastic, and what an exciting day to play. I love it. All right, let's go check out the charts. If you guys have any topics you want to discuss, this will be a good place for it. I'm going to try to do some futures. Okay, everybody's up and running well. Okay. Oh, I didn't mute the mics. Why? There's always something I forget.
You are now muted.
All right, cool. Now, where is my Thinkorswim? Here we go. We'll take a closer view than this, but this is not that pretty so far. As you can see, everybody's come down quite a bit. This is where we were 5:40 this morning, in fact. I mean, is that, wait a minute. No, that's yesterday. So yesterday morning pre-market, we were way up here. And now we're way down here. And let's see, on the S&P, which is the one that really matters, we're down 1.5% from yesterday. So that's the one. That's the key one that matters. Is 1.5% on the S&P, about 2% on the Russell over here. Here's the Nikkei. That's not the same time frame. Okay, so we had about 500 points on the Nikkei. It's also about 2%, 2.5% on the Nikkei. So we're running somewhere between 1.5 and 2.5% drops on all our indexes. Oil bottomed out at 36.64. Back up a buck from there so far. Natural gas pretty much hit that $2 mark, 201 actually, and they're back at 206, so we'll see what happens to them. Gasoline is still pathetic, but gasoline basically hit the 120 mark and is bouncing off of that. But these are just bounces, folks. That doesn't mean they're going to stay up here. You know, it's not a bottom, it's a bounce. I mean, when things hit a point of resistance, that's just a bounce. Let's see if we go to our active trader tab. Just see if there's not a particularly good setup right now. Oh, here's a good setup. If these guys are going up, see this line here? That's the first support line on the S&P, and that's the middle line on the Dow. Oh, not the Dow. Sorry, that's gold. I have gold up there. Let's go for YM. I want to see the Dow. All right. So if the Dow gets over this line, about 17,600. If the Dow gets over that line, and the S&P gets over that line, and the Russell gets over 1160, I wouldn't mind playing the Russell bullish at that 0.4 bounce, because we usually get a bit of a bounce in the afternoon. So that's one I would watch for a play right now. Let me just do, and again, I hate to do this. The problem with these webinars is they're at a certain time. And that's not how we find a play in the futures, okay? We find a play in the futures because there happens to be a play in the futures. That's why if you're a PSW member, we do them at whatever time they come up. If you're a free person who's in for this webinar, you might see, like, sometimes we put a play in our morning post. But that's completely coincidental. The reason I would put a futures trade in the morning post is because there happens to be a good setup in the morning post at the same time as I'm writing it. That's the only reason I would write about it. We don't look for them, and we don't try to force them. We look for a good setup, and usually we don't find one. But that's a key to successful futures trading, is that you only play when you have a very nice setup. What we have now, though, is a bit of a bounce, and it could turn into something if we can make these key lines over here. See 17.6, and I don't know what that line is, 206.5-ish on the S&P. In that case, if these guys are up, I'd be inclined to play the Russell, but the Russell's already above their first support line. So, maybe it's the S&P that's lagging in this particular case. But the reason I would play the Russell, though, is because the Russell is the bounciest of all our indexes. So if any kind of rally does start, the Russell could be easily good for a 10-point run to 1170, and that would be $1,000 per contract. So it is, it would be nice if we catch it. And also that you can play with very strict rules. 1160 is a good tough line on the Russell, and if they do pop it, it's going to be good support even if it comes right back down. And the key to taking good futures position is finding a position where you can quickly take a loss. Funny as that may seem, your goal is to take a very small loss and get the hell out. That's your primary goal, okay? Once in a while, you'll luck out and you'll get a win. Like if you were playing it here, you see how if you wanted to be bullish, you waited for the bounce off 2060. Here's 1160. Here's 1160. It bounced nicely up to 1164. Then it came back down and failed, but then it came back up and you made a little bit more money. Then it came back down and it failed. But if you take tight stops below the 1160 line, you only lose a little. Now it comes down, now it goes back up, and it quickly fails. So now you wait. Then you catch this cross and you make another nickel. Okay, and then it doesn't look like much, but you get up to 1164. That's $400 per contract. And now here we had one that failed right at the line, and now we're looking here. So if we get over the line, we figure it's got to be good for a couple of $100. So compare that to that I'll quickly get out if 1160 does fail, and maybe I'll lose $50, maybe $100, but my potential for a nice win is better. So my risk-reward ratio is favorable. And that's when you always want to make, and that goes to any kind of trade though. Why would you enter any trade where you don't have a better reward than you do risk? This isn't roulette. You don't have to flip a coin to make money in the stock market. You can find places where you have positive risk-reward ratios that if you consistently take things where you win more than you lose, then you only have to be 50-50 and you'll do okay. Something very, very, very few people pay attention to that concept. They like to bet all the time. Oh, that's right. All right, this doesn't look like it's playing out, so we're not going to worry about it. I'm going to move on. I know someone will tell me in chat, but unfortunately I can't see. I wish I could see the chat all the time, but I can't. I don't know if it came out. There you go. This was very good. I like this. I'm going to open up to the new window. Okay. He didn't say much, but just what he did say was important. Making smarter, better money decisions often comes down to remembering something simple, but so important. What we see, what we hear, what we read doesn't matter if we built a well-designed portfolio. That's exactly what we talked about in Washington when we had our live seminar on the butterfly portfolio, that a well-constructed portfolio is more important than anything else that the market's going to throw at you. If you build a bulletproof portfolio, then you have very little worry about all this other crap that goes on in the world. It depends what kind of trader you are. The butterfly portfolio is a low-touch portfolio that's supposed to be relaxing. It's supposed to just make money in almost any kind of market conditions, and it does. It doesn't make big money, but it makes money, and money is nice. It makes a good, reliable I'd say 20 to 40% a year. And we're happy with that. It's kind of boring for somebody. If you're a futures player or an aggressive options player, you can do a lot better than that. But a consistent 20 to 40% a year is really, really good money. And we have an incredibly low failure rate on the butterfly portfolio. I mean, incredibly low. It takes a major financial crisis to hurt that portfolio. Anyway, but here's the thing. The same thing here. It says your personal financial plan, which is also could be your portfolio. But most people, most of you guys, do this. You read the books, you look at the data, you look at the news, and that's where you decide what you're going to trade. Because you read about this, you heard about that, somebody told you something about this or that, and you trade it. But it's not your plan. There's a big difference. In other words, the most successful traders are guys who look for a type of trade that they're interested in. They could be commodities traders. They could be value traders like Buffett is and like I try to be. They could be takeover guys like Icon, he likes to shake up companies and unlock value. Okay, that's his plan. My plan is to look for value stocks, okay? When I read the news and it's about a value stock and I've got an interest in it, then it's a trade. But first and foremost, it's got to fit within my plan. That's why also at Bill Stockwell we have a lot of trade ideas that don't go in our portfolios because my portfolios have a plan. We have 4 portfolios. There's 4 different plans for 4 portfolios, but a lot of trades, probably half the trades we identify, more than half the trades we identify, don't fit in one of our portfolios, so they don't go in the portfolio. They don't go here. They're just trades that I go, ooh, that's interesting or that's interesting by itself, but it doesn't fit within our plan. And if you can get yourself away from chasing a story stock and from chasing stocks you read about and come up with a plan, something that you're going to say, I know this is how I'm betting, this is the style I'm going to be investing, this is how I'm going to run my portfolio, and these are the kind of stocks I'm going to be looking for. If you can get from this side of the table to that side of the table where you have a plan and the things you do fit your plan, and the news you read and the data you read, when it fits your plan, then you make a trade. But you don't make a trade when it's not part of your overall plan. Okay, this is a really clever little chart because it just happened to be, I just happened to read it a little while ago, and I was like, ooh, that's great to discuss. And I guess he talks about it here. There's a podcast. I haven't listened to the podcast, frankly. But I like the chart. So whether he says smart things here, I don't know. But I do like this chart because this is a problem that a lot of people have. Everybody comes to me all the time. What do you think of this? What do you think of that? They take stocks out of thin air or they heard it from somebody else or whatever, and they say, what do you think of that? And it's like, well, if it's not a sector you need, like when I look at the portfolio, especially like our long-term portfolio, when I look at the long-term portfolio, I say, ooh, we have too much tech, or, oh, we don't have enough financials in the long-term portfolio, or we need more dividend-paying stocks. That's my plan to balance out my portfolio. So I read and I look for dividend-paying stock, for financial stock, for something like that. If I see a tech stock, I don't care how good it is, unless I have one of them to cut and trade, I'm not going to add a tech stock because we got plenty of tech stocks. Okay. So, does it fit your plan? And by the way, one of the reasons I like trading futures is because I don't in the portfolios I don't day trade. But I do day trade the futures. And the thing I like about the futures is because I can play it anytime I feel like it. It's like something to do while you're when you're bored. That's another, it's another portfolio, something I do with the cash on the sidelines. But also part of a plan. Do I see a plan? And when I do make a futures trade, I don't make a futures trade that enhances my risk. So in other words, in our long-term portfolio, we have a large amount of upside positions. We have hedges in the short-term portfolio, but they're not really aggressive enough to cover a real market crash. So in the futures, I tend to look to downside futures trades, not I tend to look for downside trades in the futures. I don't look for upside plays because I already have a lot of upside exposure. I don't need to add to it in the futures. And this all goes to the same thing, though. It's all part of the plan. So even when I see a setup to the upside I like the one we're looking for here, but it's an example. But even when I see a setup I like the upside, it doesn't fit my plan, so I'm not going to trade it. All right, so let's see if anybody has questions on that. Here it is. Okay. Oh, wait, first let's take a look at the chart and see if we've made any progress. No, we have not. See, nobody's breaking up, and it's like I said, the setup I see is if they were going to go higher, I wouldn't mind betting on a move back up. But they're not going higher, so I'm not going to bet. Aim off. And by the way, if they're looking weak, I don't flip around and say, oh, I'm going to bet down now because they're going down. No, I only had a premise. My premise was it would be nice if we got a little move up into the close like we did yesterday. Here's yesterday didn't come until 3 o'clock, but at 3 o'clock yesterday we had a big pop into the close. So I wouldn't mind catching something like that if it happens again. But if it's lower, I'm not interested. We already took our downside bets off. And if it breaks down again, we're going to have to look for if it breaks 1150 and it breaks 2050 and it breaks 17.5, then I would be looking. Then we might be looking to play something lower. But right now, in intraday and into the close, I think I'd prefer to play an upside play. So I'm just not interested if it's not making it. And I'm sorry because I would love to show you guys some futures trading, but I can't show you futures trading when there's nothing good to trade. All right, so back to the questions. What's your take on ZB? I didn't know I had a take on ZB, do I? Have we been trading that at all? ZB is it's treasury bonds. It's I don't remember which one it is actually. It's 30-year treasuries, I think it is. Okay, so basically, I think I have that on. Make this up, Edge. Is that what they call Internet Explorer now, Edge? That's confusing. What? No, I don't want anything. I want FinViz. Okay, good. All right, and now we're going to look at the futures, and we'll look at the 30 years. Here's the 30-year. So who is asking that? Jake. All right, so Jake asked what I think of ZB. So that's the 30-year basically, and if we look at it over the longer term, it's pretty range-bound up here. The Fed is tightening, so in theory, it should go down a bit. It depends on how fast they tighten. I sure wouldn't bet it up. I don't see how it could really go above 160. In fact, on TLT, which is a different matter entirely, well, I have that here. TLT is a 20 years, so it's even more confusing. But on TLT, basically when it gets to 130, we short it as a rule of thumb. Hasn't done that in a while, though. But as you can see, when it was at 130, we got burned a little bit here, but we caught it then down. Then over here, we got a rock-solid drop down to 115. Then we almost got to 130. I was really upset that we missed this. It was a pretty fast spike, though. And we almost got to 130. We didn't short it here, and now we're just sitting around. But it's not. I don't think it's going to go back. I think the fate of it ultimately is to go down and down. I mean, what else is it going to do if the rates are tightening? You have to understand that these 20 and 30-year things, they're the average price of the last 20 years. So the average price of the last 20 years is here. I mean, that's the value of the, I'm sorry, TLT is the index, not the bond itself. It is a collection of Treasury notes over 20 years. And so as rates go down, they become less valuable because you're weighed down by all the bonds you got at worse prices. So they really can't do anything but go down. And now you're looking at the other one, though, is you're looking at the 30-year futures. So certainly there's been something it's been baked in a bit by the Fed. It's been baked in by what the Fed's been saying, but then the question is what's the pace, the timing, and so on and so forth. I just don't play it. That's my take on it. I don't play it because it's too confusing and too annoying. And it just depends on what the last guy in the Fed says and so on and so forth. I prefer to play TLT. It's a little bit easier to play, and I would certainly short that long term. JW, how did you arrive at yesterday's lines with ES 2090 TF? Well, we have the 5% rule, which I'm not going to go. If you go to our wiki, there's some explanation of the 5% rule there. But we use our 5% rule. You go to SPX. And really, 2100 is a line we've been shorting. But yesterday, going by the news we saw in yesterday's post, I didn't feel we were going to make it to 2100. So it wasn't like I was psyched about, so we get to Monday. Let's see exactly what I said, but I know I wasn't exalted. S&P. There you go. Okay. It's funny because I write this stuff in the morning, and so while I'm writing it, I'm thinking about what to do. I'm like, well, here's what's going on, and this is here, and this is here because of this and that and that. And then so by the time I get to this point down here, I've made a decision on what to do. And that's what happened here. So I said, so we're still shorting the top at 2100. Now, we've been doing this for how long, right, guys? So 2100 has been a line that we've had drawing the sand going back. I mean, literally all year long. See, this is here's February. So starting in March, at about 2100, we've been shorting the S&P. Anytime it got over the 2100 short, based on an overall fundamental that we see that we just don't believe the S&P is worth more than 2100. Based on corporate earnings, based on the earnings of the S&P 500, the S&P doesn't deserve to be at 2100. That's all there is to it. That's a dead solid fundamental. So this has been a steady line for us all year long, also using our 5% rule and so on and so forth. That's what we came up with as a good blocker. 1850, that's our must-hold line. That hasn't happened much this year. But so here's our long zone. We start going long here, then 2100 is where we start shorting, and that means between 1850 and 2100, which is 1975. Okay, that's essentially the beginning. So that's the beginning of the top. So we call this neutral pretty much, as far as what we priced at. And so that's the low end of our range, and this is the high end of our range. And so when we're in the high end of our range, we bet it's going to head back towards the middle at least. Not necessarily low, but we bet it'll go back to the middle down this way eventually. And that's where we are now. We're still betting for it to come back down about the 1975 area. Possibly lower, possibly get a big correction at 1850. We'll see what happens. I mean, we just got one. I mean, we just got a correction at 1850 right there. You can't expect one every month. It's not going to happen constantly. But the right price for the S&P is around, not counting, with Apple and a couple of other good companies, it's above 1850 now, because there's a couple of companies bringing it up. Also, at this point, the energy company earnings have washed out, so I'd be voting for probably 1970, probably my midpoint, or more likely, which is not much of a correction. It really isn't. Anyway, so how do we calculate? So yesterday, that's what we were talking about. So I said we're still shorting 2100 on the S&P, and at the moment when I was writing it, we're at 2090, which is close enough to begin adding a few short positions in the future. So in other words, what I'm saying is, well, we can add a couple here because I'm not sure we're going to make it to 21. If we do, we'll add more, and then our average, like let's say we had 2 or 3 at 2090, then we had 2 or 3 more at 2100. So our average is 2095 for short. That's a good spot for short. I'm very comfortable with that. All right. So then and then that lined up with. So then using the S&P as our main spot, that lined up with 17,850 on the Dow, 4725 on the Nasdaq, and 1185 on the Russell. So those all became the indexes. And I right here, same thing I'm saying right now. If any of the indexes are over the lines, we pull the plug. Okay? We don't need to play it, but if it lined up and everything looked good, that's a trade we wanted to make, and it worked out perfectly. The old fell below and never came back. If the S&P 21 is your S&P 2058, 2020 has bulls must hold lines. Wow, that's a lot of lines. We have must hold lines. We have a chart every day. I guess he must have posted some more previous post. We don't tiny lines. We'll look at the limit lines. Draw. Care about 1950, 1942, and 2035. So as we're now above 2035, yeah, that's a good support because that's our 10% line. Okay, and I drew a chart for people the other day. I don't remember where that is, but I drew a chart just the support line. That would probably be up the weekend post. Actually, I could find that. Let's say it'd be on Friday. Why am I hearing? I don't know why that makes. You guys shouldn't be able to make any sounds. Friday's post, we had a discussion about the future. So it'll be way at the bottom here. Oh, here we go. Shoot. We talk about so much stuff, it's hard to keep track. I had a chart like that for the S&P. No. No. There it is. See, so the pointer, as far as it goes, here's the example. Saying that a 2060 Why are these things messed up? It's strong support until it breaks. It's down there, obviously. It's below this chart. 206 line is the -5 line, which is the beginning of our bullish conviction. So, in other words, on the way down, we start getting bullish as we get into this zone. We get conviction when we get to this. That's why it's thicker. So, in other words, we have the 2100 line. Action to go long at the 2042 line, or whatever that is. I don't even know what line that is. But anyway, so below it, at whatever that is, and 2042 is our next line on the 5% rule, this is where we start wanting to go long on the S&P. But basically, and again, this is very important, when it's down, you play. You're short. In here and here, I don't want to do anything. Okay, if it's 100 or over 2040, whatever the hell that is, or 2047.50, when it's in between those two places, I'm not interested in playing because I don't know which way it's playing. If I play not at 2100, it could go up or down any time, and I have no idea what it's going to do. But if I play 2100, I have a very, very high probability of a successful downside trade. And don't you want that? Why trade when you don't know what's going to happen? Trade 75, 80% of the time, then trade constantly and be right half the time. Productive when you do this. Shoulda, coulda, because you say, oh, look, you went off here and fell down. It's like you don't know that's going to happen when it's here. You have no idea. Here, you have a really high chance. A bigger bet. I'm willing to make a bigger bet. By the way, you are in these zones. Once you go below this line, you should be tightening up your stops, right? You should be saying, I expect it to bounce, I expect it to bounce, I expect it to bounce. And then when it finally does bounce, you say, aha! So now you get a real bounce over here, and you say, aha, now it bounced, and it went up after the bounce. Good time to stop out and take the money. Even if you don't know to take the money on a 50-point drop. If you can't get a 50-point drop, you're too greedy to play anyway. And if you cross this line, you should start getting worried. This is your thing. So here went shooting up, kept going up, went through here, but at this point you say, that's enough. I'm done. But you're talking about massive moves, huge amounts of money, thousands of dollars. I got it every day. If I every couple of weeks, that's fine. It's a nice addition to the portfolio. All right, JW saw low, the indexes should move higher, and now you said the U.S. dollar is under 100, and Nikkei should be down. Well, if that only applies, it doesn't mean the Nikkei goes down every day. If the dollar's up, the Nikkei goes. The Nikkei likes a strong dollar. Today, which it's not, or barely, then the Nikkei would go down a bit. Right now, the Nikkei and the dollar. Wait. They're perking up. Might get our play. So the Nikkei down, well, that's from the morning, so that doesn't count. The dollar, where's my dollar? Here's my dollar. We have 0.25% not on the Nikkei. When do we open? Here, so it really hasn't moved since the open, and the clock is in the same. So it's that short term on the Nikkei, but then it's more of a reasonable level. A very strong dollar is going to hurt the Nikkei. A weak dollar is going to hurt, and that's it. It's a contributing factor to the movement of the Nikkei. All right, but don't get fooled in thinking that's the whole index. Take a look at what's going on in Japan. What are they doing economically on an Nikkei last night? Not the dollar. I had no careless what the dollar was doing. It's China's trade numbers. If China's not buying stuff, then that's bad for the Nikkei. Export economy. And again, you know, don't you dare play the Nikkei if you don't know an export-driven economy and how they're with their major trading partners and so on. I mean, that's the same thing. It's like you don't trade, understand. understand Japan and you make a point about learning all about how Japan economy functions and so on and so forth, trading expert, that's great. I spent a summer in Japan. I learned a lot about the country, so I'm very comfortable trading Japanese stuff. Because you think you know a trick, like you have to trade it based on all the facts. The dollar is a helpful indicator. So when I say, oh, the dollar is affecting the need, all else is equal, the dollar will. But just like us, every day of the week they have a data survey. They've got the same things we do. Reports just like we do. The days, and they move the markets. But other countries are a lot more cognizant of what their fellow countries are doing. Like there's more than we do. Even says Japan is completely their big import partner. They buy Japanese goods like crazy. It's very important in Japan. They have trade issues with China. They have territorial waters with China. All sorts of things go on. Japan worries more about there's so many factors. We were just talking early this morning. We were talking about the currencies in the emerging market. Asian economy, the oil currencies are collapsing because people are losing pounds. When you start trading futures in foreign countries, you just damn well move very, very. You're wrong. Deanna says, I used to watch. Recommended. Well, I'm flattered, Deanna, but I used to read way too much stuff, and I realize that most of these people have no idea what they're talking about. So I would try to read some other people as well, just to have a rounded thing. But I'm glad you consider me a reliable source. Gosh, wait. Shall we do it? I'm not looking there. I'm not. Nope. Honestly, it keeps cutting out. Yeah, here. Break the thing. Oh. The Q&A box. Call.
You are now unmuted.
And now I'm going to read.
You are now muted.
Because of this cutting out thing. I mean, that's better. So there's some background chatter that was screwing things up, I think. Hear me now? Uh-oh. Uh-oh. Voice variation. Oh boy, not. Wow, this is very slow. People are still bad. Okay, Jim, conference and seeing if it helps, because somebody's got to do it. Just tell me when you're back on. I'm not sure what's going on exactly. Connecting, reconnecting, and then tell me if it makes a difference. Because it might be hitting people we can handle. So I might have to reconsider doing. You know, we get a lot more people come in. I think we might be getting too popular. I am hearing this little noise here. Oh, okay, Jim. Okay, well, apparently we have too many people. And people aren't getting.
You are now unmuted. You are now muted.
If I disconnect and reconnect, I'm not sure if that's a good thing. All right, still choppy? All right, well, I have to ask, so let's write that. That you are now muted comes in loud and clear. Boy. And now, all right. All right, well, I'm restarting. Okay, well, it's still recording. That's interesting. Call control still muted. Oh no, I lost all the chat. Okay, well, better. All right, but I'm not screen sharing. I don't know if the screen sharing is going to kill the bandwidth, so we'll see.